Hello everyone and welcome back. In today's video we are starting chapter 4 mutual fund products and features. Have you ever wanted to invest in the stock market but felt confused about which company's shares to buy? You are not alone. Most people either don't have enough knowledge to analyze companies or simply don't have the time to track the market every day. So does that mean they should avoid investing altogether? Not at all. This is exactly where mutual funds become useful. A mutual fund allows thousands of investors to pool their money together. That money is then managed by experienced professionals who invest it in shares, bonds, and other financial instruments on behalf of the investors. By the end of this chapter, you will understand how mutual funds work, who manage your money, the different types of mutual funds available and how to choose the right scheme. So without wasting any time, let's get started. What is a mutual fund? Let's begin with the most basic question. What exactly is a mutual fund? A mutual fund is a professionally managed investment scheme that pools money from many investors and invests it in a variety of financial securities such as bonds, shares, and government securities. Instead of selecting individual investments yourself, professional fund managers make investment decisions for you. This makes investing easier, especially for beginners. For example, imagine that 100 people each invest 10,000 rupees. The mutual fund collects a total of 10 lakh rupees. A professional fund manager then invests this money in different companies and financial assets. If those investments perform well, every investor earns returns according to the number of units they own. In simple words, everyone shares both the investment and the returns. Exam point. A mutual fund is a professionally managed investment scheme that pools money from multiple investors and invests it in different financial securities to generate returns. Mutual fund is structure in India. Now that we know what a mutual fund is, let's understand how it works. Many students think that a mutual fund is just one company, but that's not true. A mutual fund is actually a system made up of different organizations, and each one performs a specific role. The basic structures look like this: investors, then mutual fund, then asset management company, fund manager, investment in financial securities, returns to investors. We will now understand the role of each organization one by one. Who manages an investor's money? Now let's answer an important question. Who actually decides where your money is invested? The answer is the fund manager. A fund manager is a financial professional who carefully studies the market before making investment decisions. They analyze companies, monitor market trends, evaluate risks, and then decide when to buy or sell securities. Their main objective is to generate the best possible returns while managing risk. Example: think of a cricket team. The captain decides which player should bat first and which bowler should bowl during different situations. Similarly, a fund manager decides where the investor's money should be invested to achieve the best results. The better the decisions, the better the chances of earning higher returns. A fund manager is responsible for managing the investment portfolio of a mutual fund and making investment decisions on behalf of investors. Who is a custodian? Now imagine that the manager has purchased shares and bonds worth crores of rupees. Where are these securities kept safely? This responsibility belongs to the custodian. A custodian is an independent institution that safely holds all the securities purchased by a mutual fund. It does not decide where the money should be invested. Its only responsibility is to keep the securities safe and ensure that every transaction is completed correctly. Example, think of a bank locker. The bank safely stores your jewelry, but it doesn't decide that what jewelry you should buy. In the same way, a custodian protects the mutual fund's investments without making any investment decisions. Exam point, a custodian is responsible for safeguarding the securities and assets of a mutual fund. What is the role of the asset management company AMC? Now let's understand one of the most important organizations in the mutual fund industry. The asset management company or AMC manages the entire mutual fund. It appoints fund managers, conducts market research, manages investments, and ensures that the mutual fund follows all the rules and regulations laid down by SEBI. In simple words, the AMC is responsible for the day to day management of the mutual fund. For an example, imagine you are organizing a school annual function. One person coordinates the teachers, performers, decorations, and schedule to ensure everything runs smoothly. Similarly, the AMC coordinates every activity related to the mutual fund. Without an AMC, the mutual fund cannot operate effectively. What is a new fund offer NFO? Let's move to the next concept. What is a new fund offer or NFO? Whenever a mutual fund company launches a new scheme for the first time, it invites investors to participate. This initial offer is called a new fund offer NFO. During the NFO period, investors can purchase units before the scheme officially starts investing in the market. Once the NFO closes, units are allotted to investors and the fund manager begins investing the collected money. For an example, think about the launch of a new shopping mall. Before regular business begins, customers are invited during the grand opening. Similarly, investors participate during an NFO before the mutual fund starts its investment operations. Exam point, a new fund offer NFO is the first opportunity for investors to invest in a newly launched mutual fund scheme. What is the role of the Registrar and Transfer Agent RTA? A mutual fund may have thousands or even millions of investors. Managing all their records would be extremely difficult. This responsibility is handled by the registrar and transfer agent, commonly known as the RTA. The RTA maintains investor records, processes purchase and redemption requests, updates KYC details, and issues account statements. Example, think about your school's administrative office. Teachers focus on teaching while the administrative staff maintains students' records, admission details, and certificates. Similarly, the RTA manages all investor related records and transactions. Exam point, the registrar and transfer agent RTA maintains investor records and processes mutual fund transactions. Procedure for investing in an NFO. Now let's understand how an investor can invest in an NFO. The process is simple. Choose a suitable mutual fund scheme. Read the scheme information document SID carefully. Complete your KYC formalities. Fill out the application form. Then make the investment payment. After the NFO closes, units are allotted to investors. Your investment then becomes part of the mutual fund scheme. Investor rights and obligations. Every investor has certain rights as well as responsibilities. Let's understand both. Investor rights. To receive complete information about the scheme. Second, to receive regular account statements. Third, to receive regular NAV updates. Fourth, to redeem units according to the scheme rules. 5. To file complaints if any issue arises. Investor obligations. First, complete KYC accurately. Second, read the scheme documents before investing. Third, provide correct personal information. Fourth, understand the risks involved before making an investment. Fifth, keep your contact details updated. Remember, investing without understanding the scheme is never a good financial decision. Always read the official documents carefully before investing your money, your hard earned money. Now we have learned what a mutual fund is, how it works, and who manages an investor's money. Now comes the most practical question. If there are hundreds of thousands of mutual funds available in the market, how do we decide which one is right for us? The answer is simple. Not every mutual fund has the same objective. Some aim for high growth, some focus on stability, while others invest in specific sectors or simply follow a market index. Let's understand the different types of mutual funds one by one. Different types of mutual funds schemes. A mutual fund scheme is simply an investment plan designed to achieve a particular financial objective. Different investors have different goals. Some want long term wealth creation, some want regular income, others want lower risk. To meet these different needs, mutual fund companies offer various schemes. Choosing the right scheme depends on your financial goals, risk tolerance, and investment period. Example point. A mutual fund scheme is an investment plan designed to meet a specific financial objective. Category wise mutual funds. Mutual funds can be classified into different categories based on where they invest and what they aim to achieve. The major categories include equity funds, debt funds, hybrid funds, solution oriented funds, other mutual fund schemes. Each category has its own level of risk and return. As we move ahead, we will understand the important categories covered in your syllabus. Open ended and close ended funds. Let's begin with the most common classification. What is an open ended fund? An open ended fund allows investors to buy or sell units at any time. There is no fixed maturity period. You can invest whenever you want and redeem your investment whenever you need your money, subject to the scheme's rules. Example, think of a savings account. You can deposit your or withdraw money whenever you want. An open-ended mutual fund works in a similar way. Example point, an open-ended mutual fund allows investors to enter or exit the scheme at any time. What is a close-ended fund? A close-ended fund has a fixed investment period. Once the subscription period ends, new investors cannot enter the scheme. Similarly, existing investors generally have to wait until maturity to redeem their investment unless the units are traded on a stock exchange. Example, imagine booking a seat for a 3-year fixed investment plan. Once the plan begins, you usually cannot enter or exit freely until the investment plan is period is tenure is over. Example point. A close-ended fund has a fixed maturity period and limited entry and exit opportunities. Difference between open-ended and close-ended funds. Open-ended funds, no fixed maturity, buy or sell anytime, high liquidity. On the other hand, close-ended funds, fixed maturity, limited entry and exit, lower liquidity. You should remember these three differences for examinations. Equity oriented funds. Now let's move to one of the most popular categories, equity funds. An equity fund invests most of its money in the shares of companies. Since stock prices keeps changing, equity funds have higher risk. However, they also have the potential to generate higher returns over the long term. These funds are generally suitable for investors who are willing to take moderate to high risk. Suppose an equity fund invests in companies like Reliance, TCS, Infosys, and HDFC Bank. If these companies perform well, the value of the mutual fund may also increase. Exam point: equity funds mainly invest in shares of companies and aim for long term capital appreciation. Index funds. Now, here is an interesting question. What if a fund manager doesn't want to select individual stocks? Instead, what if the fund simply follows a market index like the Nifty 50 or Sensex? This is called an index fund. Instead of trying to beat the market, an index fund tries to match the performance of a particular stock market index. Because these funds require less active management, their expenses are generally lower. Example, suppose the Nifty 50 rises by 10%, an index fund tracking the Nifty 50 will also try to deliver nearly the same return. Exam point: an index fund is a mutual fund that tracks the performance of a market index, such as the Nifty 50 or Sensex. Large cap funds. Now let's understand large cap funds. These funds invest in the shares of large, well established companies. These companies usually have strong financial performance, experienced management, and stable business operations. Although the returns may not always be very high, the risk is generally lower compared to smaller companies. Example, companies such as Reliance Industries, TCS, Infosys, and HDFC Bank are commonly considered large cap companies. A large cap fund primarily invests in such companies. Exam point: large cap funds invest mainly in financially strong and well established companies. Mid cap funds. Mid cap funds invest in medium sized companies. These companies are still growing and have the potential to become future market leaders. Compared to large cap funds, mid cap funds carry slightly higher risk. However, they also offer the possibility of higher returns over the long term. Imagine Imagine a company that is expanding rapidly and opening new branches every year. It may not be as large as Reliance or TCS today, but it has strong growth potential. Such companies are often included in mid cap funds. Mid cap funds invest in medium sized companies with high growth potential and moderate risk. Okay.